Well, good morning, everybody. Good morning, Keith. Thank you so much for joining our Q1 conference call here. We certainly thank you for taking the time to join us. There's really never a dull moment in the investment world, and the first quarter was no exception. But before Keith gets into his presentation, where he'll be discussing consolidation and growth frameworks he uses to identify opportunities in slower growing markets, please be advised, as always, that this presentation is for informational purposes only and is not intended to constitute a sale, solicitation, or advice. We will, as we often do, have an opportunity for Q&A at the end. But we also invite you to submit any questions in the chat during Keith's presentation in order for him to address them in the course of his remarks. With that, Keith, I will hand it over to you.
Well, good morning, everyone. We're coming here from Rochester, New York. Spring is finally here, which is nice, and we're gonna dive right into it. We're gonna start out with just the general presentation here. This is the Q1 2023 sort of partner presentation. As Jessica had stated, here we go. There's a disclosure. This is for informational purposes only. Just to give a brief overview, we've done this before, just so what the Bonhoeffer Fund is. We started in 2017. Our initial strategy was focused on value in special situations in emerging and developed markets. Recently we've expanded our frameworks to include focusing on growth drivers in sort of these consolidating markets with transition, dealing with themes of transition and innovation also. And then we're also looking at some opportunities from some of these interest rate adjustments, where are some interesting opportunities maybe outside the equity area. Those are more future things at this point, but just want to sort of discuss those a little bit and to give you an idea of what some of our thinking is along those lines. So this is our quarterly update like we did last quarter. These are the firms in the fund, the sort of a matrix of the firms in the fund that you own. So we basically had the various themes associated. We have these compound mispricings, which are basically situations where there's multiple layers in these firms where you've got, let's say, an underlying security, and they may be part of another sort of holding company, and that's what sort of and what we're trying to take advantage of there is the underlying assets being mispriced and then the discounts changing. And so that's a number of securities in our firm have that sort of characteristics. We have this mischaracterized firms, which is basically situations where one firm may be transitioning from one company to another. So we have a firm, for example, that is in the small business software market, but historically it's had directories, and sort of it's transitioning from one to the other. And what happens typically in those types of businesses is the market doesn't realize the new business won't apply the multiple of the new business until the new business becomes a certain percentage of the company. And those are those types of situations. We have what we describe as public LBOs, which are companies which have a nice recurring revenue stream, but in essence, they take on debt in their capital structure. And then we have consolidation, which we'll go into a little bit more detail specifics on that a little bit later, but that's becoming an increasingly growing theme in the portfolio. And you see over to the right what our current sort of valuation metrics are, growth versus PE, comparing to an international small cap value benchmark, and then the MSCI ex-US benchmarks. So that gives you a little idea of sort of how those all are sort of playing out from that, where those are as of March 31st. So what the main topic of today's presentation is going to be is we're talking about the major themes. In essence, the themes include value investing in sort of compound growth situations. And what we're looking for here is sources of unrecognized growth, where there is growth in the underlying business, but it's not showing up in the pricing. We're going to talk a little bit about when bigger is better, specifically consolidation growth over time, and talk a little bit about some of the drivers associated with that. And these situations also lead to situations where we're going from a situation where the company has a lower return on invested capital and transitioning to a higher return on invested capital. Some of the metrics we use to take a look at that our return on incremental capital. And those gives us some hints if that number is relatively high compared to the existing return on invested capital, that in the future, the numbers may grow. So it's sort of like a forward-looking type of an indicator there. And then the other area we're sort of looking at, and we've been spending a good amount of time on recently, is looking at profit pools across value chains. So there's some specific sort of value chains that we have exposure to. Some significant ones in the portfolio are auto and housing. And what we're looking at is where are the profit pools in those particular value chains. And then so we'll take a look at, like, for example, if we take a look at, let's say, a manufactured housing or an auto company, will say, okay, let's take a look at the autos. So let's start out from the component providers, go to the OEMs, go to the distributors and the services, and find out where along that value chain are there more profit, or where are the profit pools, and primarily identifying those based on the return on invested capital and return on incremental invested capital. And then the last thing that we'll briefly touch on is interest rate changes opportunities. So right now, what's happened over the past 18 months is interest rates have gone up quite a bit. And how has that changed the landscape and provided some interesting opportunities that we're currently looking at to sort of just to provide some some nice returns from that perspective. So the next, there we go. So the next thing is when getting bigger is better. So primarily this happens due to economies of scale. And so what happens in a number of industries is you can get higher margins and returns with larger size. Now, one of the key aspects of this particular characteristics of economies of scale is you need to identify, is the business will have economies of scale at the local or national level? I'll give you an example of this. So if you take a look at, let's say, the automobile distribution business, you have a company like AutoNation, which is the largest auto dealership company. However, they don't have the highest margins or the highest turns. And part of the reason is that versus other companies like Asbury, which is in our portfolio, Asbury focuses on a local clustering strategy. So the economies of scale in automobile distribution are primarily local, and primarily has to do with management, sharing of resources, advertising is all on a local level. And therefore, even though you're not the biggest, you may have better sort of operating characteristics. And so that's an example of that. And what we try to do is avoid sort of diseconomies of scale. You can think about what types of things get worse when they get bigger. Restaurants could be one, personal services another. So those are the areas that we sort of have avoided in terms of thinking about this particular sort of theme. In terms of cash flow, we're looking at two aspects. And there's two ways that companies basically can expand. They can either do consolidation or organic. Now, organic is much favored, and we've got a company in our portfolio that really uses a combination of both, but I think has a nice balance in the way that they do it, and that's Ashteed. So Ashteed has about 2/3 of its growth is organic and 1/3 is consolidation. The nice thing about organic growth is you have more control, and when you go through consolidation, you buy another company, you actually are buying the underlying tangible assets of business, and plus you're paying goodwill, so you're paying a premium. But if you organically grow, then you're growing by just buying more tangible assets, and you don't need to invest in the additional goodwill. So basically you have control, and you're going to generate higher returns. And you can see this in the difference between, let's say, Ashteed and URI. They're both in the same business, primarily US rental, but in URI's case, it's primarily an acquisition-driven strategy through consolidation, and Ashteed's primarily a growth strategy. And so what you'll see is higher returns on capital for Ashteed. Now, when the consolidation phase slows down, they should approach each other, because you just have to buy one of these platforms once, which is sort of like what URI is doing. But in essence, that's sort of the trade-off there. Now, consolidation, again, you look at it's either in a geography or a functional area if you're looking sort of local economies of scale, and you can enter into new. The key aspect of this, like for example, the way Asbury really uses this, is entering into a new geography or related functional area. And so that's where they've primarily done their acquisitions, but then they'll continue to grow off the specific wings that they have there. And again, this provides an interesting sort of approach to fragmented markets, which is what we're really, in this consolidation theme or approach of investing, we're really focusing on from that perspective. So the question is, and this is very interesting question, and one thing you'll notice in some of the greater investors out there now are focusing on this kind of thing, guys like Warren Buffett and stuff like that, is taking a look at the real question: is the market consolidating or fragmenting? It's an important market for security selection. If you look at a lot of the recent buys of Warren Buffett and his team, they focus primarily on consolidating markets. Even though the market may start out as a commodity market, it can get better if it consolidates. So one thing that consolidation leads to is less competition and higher returns, primarily for all the players in the market. Fragmentation leads to more competition overall. And it's interesting because you can segment this in a number of different ways. For example, I'll give some examples of fragmentation. Media distribution is fragmented, but then it's also consolidating. So if you take a look at media distribution across the different sort of media platforms that are out there, let's say broadcast TV, cable, and streaming, across those platforms, you have fragmentation because the pie is being split into smaller pieces. But within each one of those segments, there's consolidation. So the real headwind for each of these particular segments that are consolidating is they're getting a smaller piece of the pie. So again, it's an interesting dichotomy in that it's not either one way or the other. Sometimes it's a combination of both, and you really need to sort of take a look at, okay, what are ways to try and sort of take advantage of this. A good example of one that's completely fragmented, that's really caused a lot of investment issues for a number of years, has been airline and trucking deregulation. So airline, when they were originally deregulated, and trucking was deregulated, it just became this huge commodity market. Now you have consolidation in both of those areas. So over time, this thing changes. So you can get fragmentation and consolidation. And I think focusing on the areas of markets that are consolidating is where you really want to be and where you can find some really interesting returns. Because a lot of this it's not going to necessarily be priced into the price of the stock because it's more of a future trend that's going on with these businesses. So some examples of consolidation. There's equipment leasing. You've got URI and ASHI. That's examples in the U.S. Automobile distribution, Asbury and Lithia. It's an example of those are being consolidated because there's right now there's very few. The larger players. Automobile distribution is very interesting because it's a hugely fragmented market. And if you look at the publicly traded companies, their primarily competition isn't each other. It's actually other mom and pop owned sort of local businesses that are there. So that's another interesting aspect of this kind of thing. In value retailing, there's Academy Sports and At Home in the US, and then connectivity is Consolidated Communications and Frontier. And I think connectivity again has sort of this dual segment where you've got a fragmentation with a consolidation. You've got consolidation within a certain segment, but then you got a fragmentation because you have a new, these over-the-top fiber overbuilders combined with the existing cable companies. So that's another one where it's not a black and white, but it's sort of a combination of both. And you really need to take a look at each of them and find out, okay, what are the dynamics of the market you want to be in over the long term? Again, we're looking for longer term trends here that we can take advantage of over time that may not be reflected in the stock price today. So we're looking, the time frame we're looking is like, 5 years plus in terms of some of these trends playing out. Some of these trends, consolidation will play out over 20 years, and we're just trying to get it somewhere along the line there to take advantage of that, where the market may not be capturing that. One way you can take a look at that or see evidence of this is if you look at like companies, for example, take a look at some of the automobile dealer companies like Asbury or Lithia. Over time, what you see is this price charts go up and to the right. And what that tells you is the market, it's growing, but the market's not anticipating it. If the market had anticipated the growth, all it would shoot up and then it would be flat. But going up and to the right basically is an indication that the market isn't fully incorporating all the synergies and the potential growth that consolidation is generating for these types of businesses. This is just basically some of the characteristics we look for. We're looking for long runways with consolidation. So you not only are getting revenue growth, but you're getting economies of scale and scope, which is providing operational leverage. So your earnings are growing faster than your revenues. Now, another thing with fragmentation is innovation, like the internet, can add additional fragmentation. That's one thing you need to be aware of in these markets. And I think we've provided examples of that. So for example, in the in the online in the automobile distribution business, it has created some fragmentation, especially in the used car market, where Carvana and other sort of people have come in and provided some more fragmentation in the market. What this thing does provide, though, is given the number of opportunities that are here, we can select across markets and geographies some very interesting opportunities. And of those, pick the ones that we think have relatively the consolidation aspect of it provides the growth. And then we can find some very interesting value, what we think are valuation mispricings as a result of that. Another aspect of this to take a look at is to take a look at incumbents adopting the innovation. So in most cases, when innovation happens, the incumbent wins because the incumbent can adopt. If the incumbent can adopt the innovation, they can win because they already have the customers. The new guy coming into the market basically has to go ahead and get the new customers, and that's a huge barrier to entry for them. So unless the new entry into the market has a totally new value chain, and the existing providers in the market has to destroy their value chain to basically service the new customers, then the incumbent's typically going to win. So the real question in these consolidation things is, where do we want to invest? Now, right now, where our focus has been is sort of in this early stage where the top 5 have left less than 15%. And there's sort of a trade-off here. Again, if you invest too early, you're going to have a period of time where stuff just doesn't go for a while. But if you invest just at the right time, you'll see it pay off. A good example, a good analogy, I think, here is probably real estate investing. If you invest in, let's say, raw land outside of, let's say, an urban area where everything's moving in the right direction, you're probably going to do well. But if you just buy raw land in the middle of nowhere, eventually it may do it, but you may be there for a long period of time. So we're trying to find where in this early stage does it make sense, and where are the best opportunities from that perspective. And so in the early stage, you can see some advantages of local economies of scale, and then it's these future advantages that we're really looking for, which will drive the price going forward. So examples of these types of businesses that we're currently invested in is US auto, European car dealerships, auto rental, equipment rental, and sort of plastic packaging. Now, as consolidation happens later on, what happens is you actually see the scale, the future increases in these scale economies are not as great. And so basically we're dealing more with the traditional values. Some examples of these types of businesses right now are sort of can packaging. There's like 3 big players there. A lot of the North American building products are this way. In US auto rentals, there's 3 guys in that market. So in essence, we're trying to focus on the earlier stage because the market hasn't necessarily incorporated a lot of these sort of scale characteristics in the business. Now they have incorporated some, so there's probably going to be some premium, but it's going to be a lot less than, let's say, people that are in sort of the later stages of this consolidation. So some other factors that basically lead to favorability of sort of consolidation is economically driven ownership. Now, for example, if you look at some of the automobile dealership companies, a lot of them are driven or run by families. Some families are going to be economically driven, some aren't. So in essence, the guys that will be able to focus on economically driven factors, the publicly traded ones, I think, have an advantage over those that don't. The other one could be friendly regulatory and cultural regimes. So where we're seeing most of this consolidation, where most of it really seems to be happening, is in the United States, the United Kingdom, and then in Scandinavia. Because those just culturally, those are more attuned to those types of cultures. A lot of places around the world, the business culture is not attuned to do consolidation because the focus is more on, most of the businesses are owned by families, and they have other considerations beyond pure economics to own and control these businesses, and therefore consolidation is not a big factor. So the places where we are focusing as a big factor, again, are the US, UK, and Scandinavia. Those places seem to be the biggest places where right now it's currently. Now what's happening in Europe is, I think, it's changing. So again, that's another potential interesting area, because there are parts of Europe that are emerging as being more focusing on this economic aspect of these businesses. And then the other question is there supplier support? Because supplier support is important also if the suppliers don't want you to consolidate, they can put up some roadblocks by, for example, in the US, you have exclusive territories from certain dealers. They could say, okay, we're going to limit the amount of dealerships you can get within certain markets. I think at one point, a lot of some of the Japanese OEMs were doing that, but I think they've sort of moved away from that now. So I don't think that's as much a concern, at least in the industries and the companies that we've been looking at. So we talked about this last time, but I'm going to represent this again because I think this is an important aspect of consolidation. There's some really good models out there. I mean, if you're interested into really diving into this a little more, Scott Management and this Canuck analyst put together some really good benchmarking for consolidation activities. And so what we're really looking for is, again, situations where future returns are based upon successful implementation of a strategy that's already been laid out and others have done. In most cases, that's sort of what's happening in consolidation. We can provide good returns to minority shareholders. So that's where we look at management and say, okay, what have they done in the past and what are their incentives to basically provide good returns to shareholders, and how much of the growth is really factored into the price today. And I think that's where, in the previous slide we talked about earlier on in the consolidation cycle, I think that's where we try to focus is more earlier on from a consolidation perspective, because it's not really priced into the price today. And again, we're looking for sort of these, what's described as these Davis doubles, where we can get high growth for modest multiples. And part of this consolidation, the consolidation aspect of it allows the growth to be consistent. In other words, for us to feel comfortable, the growth is going to continue at least for 5 or 10 years going forward. And therefore, the multiples that we are paying are under what the value should be. Again, so here's sort of the range of consolidators. Some people focus on more of this platform accumulator aspect. Some people look at holdcos and roll-ups. I guess where we would sort of fall into this is we're primarily focusing in the roll-up aspect of the businesses. Platform and accumulators are ones where, or I would say roll-up platform accumulators are more where the companies are buying unrelated businesses and then applying specific practices from one business to another. And those are a little bit, I think, tougher personally, I think they're tougher to assess. And right now, the valuations of a lot of those businesses are relatively high compared to, let's say, some of the more pure roll-up and platform types of businesses. There has been, as you can see from other people looking at this, there has been a good amount of analysis and other investors looking at, and a lot of the effort that I've seen, at least publicly, has been more on this accumulator platform aspects. Roll-ups have a bad reputation historically because a few of them have classically blown up on guys like Tyco and some of these other things. But the reasons that they blew up have to do primarily with, fraud and other aspects of it. I mean, I don't think that negates the strategy itself. It's just that you need to have a good management team that isn't going to do that. And you also need to be aware of the prices that you're paying. And my background being a business appraiser, continuing to do business appraisal that sort of plays to my set of tools that I have in my tool chest. And therefore, that's why I've sort of focused in that area. This is another sort of aspect of it. As you can see, the key things to monitor for the types of business we have is sort of the market share for the top ones. That's, again, we sort of went back and we looked at that. We're trying to find guys with low but growing market share. Sometimes the international expansion record, you need to really critically look at that. For example, in a lot of the auto dealers, some guys have expanded into Brazil and then they pull back from Brazil. A few of the guys have expanded into the UK. I've looked at the UK market. We used to own a company in the UK market called Cambria Automotive. That market is a much more competitive market than the US market. And even the best players in the market haven't done well, at least in my opinion, over time. And therefore, I'm not sure whether that international expansion to the UK is really going to help. Lithia recently announced an acquisition into that particular market, and I'm not sure how that's really going to work out because it really hasn't. From a European perspective, the UK market has been places where in my opinion, where auto dealers have really had a tough time and will continue to because the competition is just so tough. In terms of the platform, we want to look for historically record of what types of businesses have they bought in terms of things to monitor, and the delegation of the M&A authority. I mean, I think the nice thing about some of those things is you can sort of see that just through the way that some of these companies operate. And one thing from the platform perspective, I mean, you can actually look at as Ashtead as being an example of that, because they actually have a core platform, which is primarily general equipment rental. But then there's all these specialty things that they're buying onto it. So they're, in essence, they're sort of a platform company using that aspect, and they use their built-in distribution advantage from a geographic perspective to overlay these other types of equipment that they can distribute and service as a result of that. And this is just another, I think, a nice way to think about this is that when you're looking at a framework of sort of what types of, what you actually see is that as the companies get bigger, the return on invested capital and the organic growth rate basically decline over time, which I think intuitively makes sense. And we're trying to look for companies that basically will continue to do spend, but have higher return on invested capital and organic growth. So we're trying to look for companies in the 15 to 20% plus range. They're selling for reasonable multiples that will have sort of long runways going forward. So one of the things that we've really started to focus on more recently has been sort of this value chain analysis, looking where in the value chain is there the profit pool. So for examples, there's in the autos, we talked a little bit about that. In that value chain, there's a lot of value, I think, in the distribution business, high returns on capital. There's also a good amount of value in the rental aspect of those businesses. So companies like Sixt, Auto Hellas, which is one that we recently purchased, is another example of that. Housing, right now, housing, I think there's some interesting places in that value chain. Look, there's mobile, modular housing is one area. We're looking at some of those types of things. There's also sort of leisure, RVs, and marine. One of the companies that we do have in our portfolio that's tied to housing and construction in general is Builders First Source, which is a distributor, which is where I think you can find a lot of the profit pools in these businesses, because in essence, there's not a whole lot of capital invested. Primarily, it's working capital, and if they have good working capital management, the returns on capital can be very nice for those types of businesses, and they can continue to grow as there's still a good amount of sort of fragmentation in some of those markets. And so what we do is we'll take a look, like we had mentioned before, we'll sort of follow the value chain. So we sort of take a look at all components of the value chain. You've got components, OEMs, distribution, and service. So for example, if we're looking at automobiles, you can say, okay, well, there's components. There's tier one suppliers and components that go into the automobiles. You've got the OEMs, you've got distribution and service. And those particular ones we focused on primarily the distribution and service aspects. Now, the nice thing about dealers is they actually provide those last two aspects of the business, and they can do relatively well in that in terms of higher returns on capital. And then the other question you need to ask, is that being disrupted, or is there anything that's going to replace it? And as far as we can see, there's really not a whole lot. Going from internal combustions to electric vehicles, there's going to be some changes, but I think based upon the experience from Bilia and other guys that are sort of on the cutting edge of this, people still require service. It's just a different type of service. And the guys that provide good service for internal combustion engines will basically can provide, it's a different skill set, but the adept operators will also provide good service for EVs. And Bilia is doing that in Scandinavia right now. And so again, we're going to looking at we're going through this, we're examining the growth drivers of large profit pool firms. And so we're looking at consolidation, organic growth, cyclicality, and transitioning businesses. Now, the one thing that's interesting about cyclicality is that some of these factors can offset some of the cyclicality of the businesses. There's two specific areas that you can see this going on right now. One is an equipment rental. You take a look at the margins of like URI and both Ashtead in this cycle compared to the last cycle, they're up by about 10%, which again sort of shows the how even though it's cyclical, it's growing. And you also see some of this in the automobile distribution in the dealers right now. I mean, I think you'll have some offset of right now the GPUs are relatively high, the gross profit per unit for those businesses, they're coming down. But for guys like Asbury, you actually have some offsets for that, which would basically be sort of their online business, where in essence they can get growth in online businesses for very low cost customer acquisition costs to offset some of the GPU decline. So what we're looking for is we're looking for situations where the market's going to see this as a big cyclical, but then there's other factors that are making it less cyclical. And what are those, where are those businesses and how much of that can sort of play out? And does it make a material effect on what's really going on with these businesses over time? So the real question, I was listening to a podcast by Morgan Housel recently, and he had a really good quote. He said, as investors, what game are you playing? And so I think what we're trying to do in this case with some of these, I guess we'd say are more cyclical firms, is what most people try to do is they try to time the cycle. And that can be very difficult. When I look at most of the comments for these types of businesses through various types of more professional forums like Value Investors Club and other comments from other people, is that people seem to be, in cyclical firms, seem to be focused on the cycle of the business. And that may be, that's an important aspect of it. But if the business is becoming better and less cyclical, then I think there's an opportunity there. So what we've done is we tried to identify growing cyclical firms and focus on companies that have high returns on invested capital and incremental invested capital, which basically will provide us to say, okay, well, there's cyclicality here, but it's getting a little better. And again, we're sort of trying to focus on the drivers of cash flow growth, which for us really provides us some interesting, I think, opportunities. And these growth can come from a number of places. You have consolidation growth that we have mentioned before, companies just merging together. Organic growth, which I think is obvious. And there's cyclical growth, which happens at various parts of the cycle. And then there's operational leverage, which will convert your revenue growth into more earnings growth on a leveraged basis. And so that's primarily the consolidation. I don't know if maybe I'll stop here quick before we go into the interest rate sort of changes. Does anyone have any questions or on that particular sort of aspect of what we're trying to do at Bonhoeffer? We did get a question early on that primarily was associated with what's the difference between Lithia and Asbury, and why is Asbury selling at a discount to Lithia? And I think part of the reason is that Lithia has been doing this for longer. I do see some differences between the two, and I'll give you some examples of why I think Asbury is. Both of them are going to do well. I just think that I favor Asbury over Lithia. One of the things, an example of that could be is the way that they're sort of running their business from a clustering perspective. Asbury focuses on clustering, and one of the things that they'll do, both these dealerships do now, is that both of them have online car purchasing, both new and used cars, which I think is going to add a great value, a huge value driver for both. But if you take a look at the difference between Asbury's and Lithia, Asbury says, okay, well, we're going to deliver the car if it's within 20 miles of our dealership, because they have the local scale and they can deal with the ecosystem and adding what's going on with the ecosystem there. Lithia has a much wider or longer range place where they'll basically deliver the car a few hundred miles. And I think the big thing is that when it comes to these clustering, you want to focus on the local areas. Now, so it's costing Lithia more to deliver those cars, and I'm not sure how much service of your cars a few hundred miles away, how much service you're going to get. But Asbury's focusing more on the local aspect of it. The other thing that I'm a little bit more hesitant with Lithia is they made recently a UK acquisition, and having been involved with that market through Cambria historically, it's a much more competitive market, and I'm not as confident that their expansion in the UK is. I know that probably the returns on capital are not going to be as good as the markets they have in the US, and I'd much prefer them to stay focused in the US. I know Group One has basically expanded into Brazil. Now they moved back. They basically going to sell that. So I think from what I've seen in terms of the markets around the world, the US seems to be sort of uniquely positioned to do relatively well in this auto market, just because the nature of the market and a lot of the family-owned businesses going into other countries. Although it may be good, I think it's going to dilute the higher returns you can get in the US, at least in my opinion.
Keith,
Yeah.
Keith, we had another question come
Sure.
in. Chris, I'm happy to ask this from the chat, but how do you view the used dealers versus the integrated new used ones in terms of industry structure, opportunity, runway?
So I mean, the used dealers, I think the initially it was the CarMaxes, and again, the CarMaxes using local economies of scale doing relatively well. You got Carvana that's 100% online. My I think the if you focus in that, I think you can do well. I like the integrateds because you have more than one stream, right? I mean, these remind me a lot of like banks where you have multiple streams. So I mean, I would much rather now the real question is, are they focusing on it enough to make a difference? And the nice thing about the integrateds is that if you're going to have a physical footprint, having both a new and used using the same physical footprint provides you some economies of scale there. And with the tools that are available now today, you can get the automobiles out there and for people to look at them and buy them. So I think what's really happened in the market is there's sort of probably been a melding together of the new and used market in terms of what people can actually buy from that perspective. So I think, it's the integrateds I think have some advantages. Now they can, some of them can squander the advantages and provide poor customer service and all that other kind of stuff that we all hear about, but that's true. But there's other guys that are going to provide good customer service. And so I mean the nice thing too is that the new guys get all the off-lease vehicles, and I think that makes a huge difference in terms of sourcing, especially now with with where automobiles are. And so I mean, one of the challenges of both CarMax and Carvana is getting new cars, right? I think Carvana has other issues too, just in the fact that they probably did well when they were smaller, but then scaling it up and making a profitable model, I think is at least in my mind an issue from that perspective. I think CarMax has done well in terms of their model, but again, I think if you look at the profitability of an auto dealership, the most of the profit comes from service and other things that they can provide. And without that additional profit, let's say that a CarMax wants to provide, I mean, their model was intentionally don't provide service. I think it really makes it on a return on invested capital, maybe not quite as good as the integrated model, where in essence you have the ability to service these vehicles over time, which I think is going to be a very valuable thing over time. And if you do a good job and you go back and you continue to get repeat customers, I think there's a lot of sort of value added stuff you can really provide there. Of course, there's going to be people in both cases that are going to abuse people. I mean, the other thing about both having a new and used, at least in this cycle in particular, is that it's providing a little bit more balance. The used guys are really getting bounced around by just supply issues now because of the COVID shortages and them just trying to get cars. With the new, you sort of have a combination of both, so you can sort of smooth the stuff out. So I see a correctly managed integrated firm having an advantage over, let's say, a pure used firm at this point, just in terms of being able to provide more steady and consistent returns on capital from that perspective. But clearly, I think the thing that CarMax has is they clearly have a huge advantage over everyone else from a size perspective, and to a certain extent Carvana, but Carvana at this point still hasn't made any money. I mean, at some point, I think Carvana is going to have to restructure, and it'll be interesting to see what they look like coming out of it. But if you look at how these models have performed in Europe too, it really has been a challenge for the online only guys, especially the ones in the UK, which is a more competitive market, or even the ones in Europe, like an Auto One in the mainline market. You'll have guys that are more like Bilia, who provide service in Scandinavia and some parts of Europe, performing much better than these other the other dealers that are out there. So I think the nice thing about an integrated dealer is you have more levers to pull and more places to potentially. You have a lot of profit pools that you can draw from, versus like a CarMax or a used only. You don't have as many profit pools to draw from to to create a good return on capital for your investors. Not saying that it can't be done, but it's just that it's a more, I think in my opinion, it's a much more difficult exercise. Hopefully that answers your question. Is that so? That's the aspect of consolidation. Like I saying right now, some of the things we're looking at in sort of the consolidation areas, we're looking at maybe some other sort of other businesses that are maybe sort of construction related that basically are sort of recurring from that perspective, and also looking at maybe some of the mobile home trends. I mean, I think mobile homes is a real interesting area because right now it's at a huge cyclical low that I think is going to turn around because of this affordability issue. And then also some potential component suppliers in those, because I think the component suppliers have really sort of optimized and been able to it's an interesting market because I think what's happened there is the OEMs, from my perspective, it seems like the OEMs have gotten squeezed from optimal component providers providing good stuff, and then the dealers on the other end of it. So it's it's a little bit of a different market than you typically see. Typically, you'll see the OEMs do well. But especially in the consolidation aspect of those businesses, because in the RVs and the mobile housing business, you've basically got three OEMs. So usually in those kind of situations, the OEMs do well, but I think from the RV perspective, it's a little bit different. But yeah, I mean, it varies, and those are the kind of situations we're looking for because there's very similar characteristics of those to some of the local economies of scale and density issues that we see in both dealerships and in sort of equipment leasing. So they're sort of like parallel areas that we've been looking at. So if there's no other questions, I'll move on to, you can always ask questions at the end also. I'll go on to sort of changes in interest rates and where there's some real interesting, I think, opportunities. We talked a little bit about this last time. Again, what's happened is there's been a reset from positive from negative rates. Both stocks and bonds have declined at the same time. So what you've got is a reset of a lot of interest rate related type stuff. Inflation's present, but the future's uncertain. Today, I think they said interest or inflation was lower than expected. I would think inflation is going to continue to go down. The forces that have created this decline have maybe moderated and changed a little bit, but I still think the major forces are still in place. The big question people have is a lot of stuff with China. If trade does get impinged with China, I think what's really going to happen is you'll find other places that will sort of pick up the slack there. But as far as I see, it's really in no one's economic interest to sort of impinge that at this point. So I think it just continues to move along. So as an example, sort of what's happened right now, currently, I think rates are around 1.5% real if you take a look at the tips versus a long-term trend of 0.7. I'll bring up this next chart, which is sort of a long-term study of interest rates, real interest rates over time, going back to 1300. And so what this is really showing is that it's showing over time, real interest rates have declined, which is sort of expect. I mean, as capital accumulates and as the overall world becomes more prosperous, you expect expected returns to go down and the cost of money to go down. And so this is sort of like a graph going way back to the 1300s on this. And right now, the intercept of that right now is probably about 0.7%. Eventually, it'll probably approach zero. But right now it's 0.7%, and at the real rate's 1.5. What that would say is that, to get down to sort of that the average that the thing seems to be bouncing around over time, that in essence we still, there's still some downward pressure for that. And I think some of the forces that are there that drove it in terms of, relatively low wages and I guess a lot of there's a trade-off between wages and productivity, but I think what's going to happen over time is a lot of those factors are still in place. I mean, we saw it happen in China, but I think those same factors are happening in other places like India and then eventually Africa, which will drive sort of the same sort of situations in those countries. So I think we still have a long runway for deflation or disinflation to continue to occur. I mean, the one caveat on the things that really cause inflation is shortages. And there's three things that cause shortages: war, famine, and epidemic. Now, I hope we don't go down any of those, but if those do happen, then those are the places that will create the shortages, which will create longer term sort of embedded inflation. We've done a lot with epidemic, and despite, with COVID, I mean, you think back a few hundred years ago, and people regularly dying, and that's part of the reason why people had so many kids, is people regularly dying from disease was a normal part of life. Now it's not that at all in the Western world for the most part. You hope war becomes less feasible as countries become more integrated from an economic perspective, and realizing that war will destroy their economies. And then famine, I mean, there's just the huge amount of, with the Green Revolution and continued, advancements in productivity of creating food, just continues to really being that as, becoming less and less of a possibility. Right now, that doesn't really happen in the developed world. So the three things that have historically caused inflation, in my opinion, have been tamed, and therefore we should expect a continued sort of downward slope of these aspects. Another aspect that's going to create deflation is debt. Debt has a tendency to create deflation primarily from the point of the more debt you put on, assuming you're going to pay it back, that you're basically taking consumption from the future and pulling it to the present. So the future consumption becomes less, and therefore the inflation becomes less. And so I think that's going to continue on. The key behind that, though, is that you're going to continue, you're expected to be paid back. And I think at this point, making an assumption that isn't going to happen is very difficult. I mean, there's a guy, an economist called Lacey Hunt, who does a lot of work in this. And, I'm a firm believer, and Irving Fisher has also come up with his debt deflationary hypothesis, which I'm a firm believer in terms of how that really affects inflation over time. So I think, and so that's why I think these interest rate plays at this point become very interesting, because I think if we're in a position where the interest rates have reset, come back up to like 5% for the short rates, if over the long term it goes back down to maybe, let's say it goes down to like 3%, I mean, there's some really nice, interesting opportunities from that perspective. One area that you want to do is sort of what are sort of the investment options under this type of a interest rate reset. One thing you want to make sure is that there's enough upside to compensate for higher expected returns in equities. If you guys haven't looked at, Aswath Damodaran has a very good site where he tracks both the equity risk premium and interest rates, and he sort of combines those together to get an expected return for stocks. If you look at how that's changed over time, it's up about 200 basis points. So you need to make sure in the investment that you have that your hurdle rate is above that aspect. And I think in the situations that we're looking at, I mean, we're looking at trying to get, returns at a minimum. We're trying to get returns in like the mid-teens. I think we're above that benchmark, above that sort of change that's happened right now. So I think the equities we're looking at are interesting places. I think another interesting aspect that's happened, though, is fixed income has really sort of been, there's some real interesting fixed income aspects what's going on today in terms of the market there. Again, you need to ensure there's enough spread to compensate for both duration and credit risk. At this point, from a duration perspective, the Fed's really using short-term rates to control inflation, and therefore, if you have short-term adjustable debt, that's basically going to reflect that. That's going to be part of that. And so I think that's where you really want to be in terms of on the duration aspect, adjustable rate to sort of deal with any potential sort of increases that the Fed will pump up over time. And then the other aspect is credit risk. I mean, one way you can look at credit risk or evaluate credit risk is look at some historical underwriting over multiple cycles. And you can use things like portfolio interest coverage and leverage ratio to assess the risk. Distress, I think, is an important skill set to have in this type of environment, because there is going to be some distressed opportunities where people can take advantage of that. And another thing, if you look at take a look at portfolio industry composition is going to be very important, because if you look at some of the portfolios, maybe if they're tilted more towards the traditional, what I would call high yield type companies that are more mature industries and declining businesses, those are more challenging and much more difficult, I think, to underwrite than, let's say, companies that are lending to, let's say, software businesses that are growing. So I think there's an interesting dichotomy there. So some of the things that we've been looking at is there's some real interesting BDC opportunities that can provide 10 to 12% interest rate spreads over short-term rates right now. Right now, we think that, so short-term rates are at 4, so you're talking about expected returns of 14, mid-teens. At this point, there's competitive rates with equity, which is mid-teens, and we talked about before the benchmarks we saw there for equities. Expected returns on an overall market basis is 6 to 8%. We're talking about mid-teens here for debt type of things. The key thing is finding the better underwriters, and some of the better underwriters in the BDCs actually have had positive realized gains over time, which basically means that they, over time, between the losses and the gains, they've sort of canceled each other out, and so the NAV has stayed the same. One of the challenges from a BDC perspective, in most cases, the NAV gets attrited over time. So in essence, you're buying a melting ice cube. But there's a few cases where the ice cube is pretty solid and you're getting a nice interest rate. You're basically being paid a very high coupon while the ice cube stays solid. And so that's I think that's the key piece. And is finding the BDCs where the ice cube isn't melting and where it's staying pretty solid. And some of these are currently available around book value. Some examples that are out there, there's a Sixth Street and then Ares Capital are examples of sort of BDCs that are, I think, are interesting at this point. But these are more of just, I think, opportunities as a result of interest rates, the interest rate changes that have happened, in specifically looking at some of the situations here in the United States. So I don't know, that's all we had for the presentation today. I don't know if anyone else has any questions in regards to either consolidation, the portfolio, interest rate changes, so any questions folks have, just let me know, just let us know, and we can address those.
Happy to have you enter them into the chat, or feel free to unmute yourself to just ask a question live. Hi, Jag. Looked like you wanted to ask a question. I unmuted you. Oh, no. Okay. Not to put you on the spot.
Okay.
I just wanted to help you out.
Thank you.
Well, I'll take a moment just to remind everybody, hopefully Keith will be doing some traveling later this month, and he will be attending the Fairfax meeting in Toronto. And then also he'll be part of the Willow Oak presentation, an investment meeting in Omaha after the Berkshire Hathaway shareholder meeting. So if you have plans to be there, hope you can join us. Please reach out, and would love to set up some face-to-face time if possible. But if there are no other questions, we will go ahead and close out today. And again, thanks so much for the time. And we will share the recording of this as well as Keith's deck and resources that he mentioned post-meeting. So thanks so much for joining us. Have a great day.
All right, thanks.